demystify some of the complexity of commercial real estate. Your goal is to maximize the loan proceeds for your client. It's really helpful to understand the way the lenders think, the questions and the information and the details in the underwriting process that the lenders are going through. Okay, today we're going to talk about in this video the difference between recourse and non-recourse. Now, a lot of people don't even know what these terms mean. And if you are coming from a residential primary background, you might just not use these terms at all. In commercial real estate, we use these all the time. We just talk about how deals are non-recourse. Why? Because if you're the borrower, you find it really, really important that the deal is non-recourse. Why? Because it means whatever happens to the property, the lender can't come after you, right? As long as you're not fraudulent or negligent, as long as you do your job. If things just happen to go bad, the economy tanks, the neighborhood goes to hell, whatever happens, and the property can no longer support the mortgage, the lender's not going to come to you and demand that you pay for the property. They're going to look to the property. And that is the main difference in what recourse means and non-recourse. It simply means if something goes wrong to the property, what recourse does the lender have? The recourse is either to the borrower or it's non-recourse to the borrower, and the lender can only go after the property. It's that simple. Don't get any more confused by it. Don't let any detailed language, don't let anybody come and tell you anything else. It simply means, does the lender go after the borrower to collect his money, or does the lender go after the property to collect their money? That's how it applies to commercial real estate, as far as I've seen in my entire career. If you have a different way of looking at it, please leave a comment down below. I'd love to hear that. But I look at it that simply, and it's done me well in my entire career. Now, what I want to do is a little bit more complicated than that, a little bit more interesting than that. I want to think about why. Why would one property be recourse to the borrower and commercial properties not be recourse to the borrower? And to do that, I drew my little pictures up here, right? I've got a single family home. And off the bat, just the fact that I call it a single family home, it's not a rental property. I live in it, or somebody lives, not me, somebody lives in this property, which means the property itself doesn't generate any revenue. It doesn't make any money. It has a value. Certainly the property itself has a value. And of course, the lender is going to look at that as collateral for their loan. But right now, I'm not even talking about collateral for the value of the loan. I'm talking about who's going to pay the mortgage. Can the property pay the mortgage? No, there's no income coming off the property. It doesn't generate any revenue. So the only person that the lender, the only entity, the only being that the lender can look to is the borrower. And that's why any of you who might be from a residential primary background are immediately probably nodding your head saying, yeah, of course, we do a deep, deep dive on the borrower. We're going to check their employment history. We're going to look at their DTI, their debt to income ratios. We're going to check their credit score, of course. We're going to look at their sources of income. We might be looking at their tax returns. So there's a lot of things we do as a deep, deep dive on the borrower's financial strength, not just their net worth, but really their current income that comes in month after month after month to make sure that they can cover the mortgage on the property. Let's contrast that with commercial property. On commercial properties, the property itself makes money. It generates revenue. It has income, it has expenses, it has an NOI. And you're going to look to that NOI to be able to cover the mortgage. Hell, I'm using that word cover, right? That's what a debt service coverage ratio comes from. A DSCR is the ability for the NOI to cover the mortgage. And all a debt service coverage ratio is, that ratio is a measure of how many times over the NOI can cover the mortgage. A 1.2 DSCR ratio means that the NOI has 1, that's the even, it would just cover it, and plus a 0.2, another 20% of NOI is available to, as like a surplus. After you pay the mortgage, there'd be 20% left over as cash flow. That's a cushion. And we'll go, there's other videos where I'm going to talk about DSCR, but in general, I just want you to recognize that on a commercial property, the lender is going to look to the property and the property's income generating abilities to pay for the mortgage. They're not going to look to the borrower. Now, that's so long as the borrower doesn't do anything fraudulent or negligent. If they're a bad boy, then they kind of void all these carve-outs. That's why we call them carve-outs. So that's non-recourse. And that fundamental difference is what drives so much of the origination process, so much of the due diligence process that we all go through to originate mortgages for these types of properties. Because again, if it is a recourse property, then I need to do a deep dive on the borrower. If it's a non-recourse, then I don't really need to look at the borrower to pay the mortgage currently. I look at the borrower to just make sure that they understand their business? Does the borrower have the right experience? Do I have trust that the borrower can manage a team, can manage the property, has the financial wherewithal to be able to support the mortgage in the short term? I'm really just looking at the borrower's experience. And you'll notice that as we go through due diligence in commercial real estate, the deep dive that we do on the borrower is more so related to the borrower's experience with this type of property and this type of investment style, construction or renovation or purchase, than we are about their financial strength. Of course, the lender's still going to look at the financial strength of the borrower. They're going to look at their credit scores. They're going to look perhaps at their tax returns or certainly their PFS statement, their personal financial statement. But it's less about looking to the borrower to support the property and more just making sure that that borrower has experience. If they don't have any net worth, it's going to draw into a question, are they even capable or in a position where they should be acquiring or owning a property of this caliber? That's more of the look. And let's talk about a couple other things. Just as we've been speaking about right now, who pays for the mortgage? Well, in a residential property, it's going to be the borrower. On a commercial property, the property is going to pay the mortgage. What kind of an entity is usually the borrower? Well, in a single-family residential, it's probably it's just an individual. You don't usually, I don't think you can even do a residential loan in the name of the borrower. I think in the name of an entity. I think it has to be in the name of an individual. On the LLC side, on the commercial real estate side, you're going to be purchasing that property under an entity, right? Usually an SPE, a single purpose entity, usually an LLC. Sometimes it might be a C corporation for some other reasons, but in general, it's going to be an LLC. Who's obligated to the lender? Again, because it's a recourse property, the obligations fall on the borrower, and because it's non-recourse, the obligations fall to the property. And what are the exceptions? There really aren't any that I'm aware of in a single-family home. It's always going to be recourse to the borrower. There are exceptions on commercial property, and those would be for construction or renovation deals or a heavy renovation. And there are different types of loans, and this is primarily why a construction loan is just a completely different type of animal than a long-term rental loan. And if you stop and think about that for a second, it makes a lot of sense why a construction loan would be recourse to the borrower. Think it through for a second. Got it? Right. Because there's no property. On a construction loan, you got dirt, usually, or on a significant renovation, the property is going to be vacant for a while probably, or you're going to tear it down to its studs and rebuild it. There's going to be no income coming off the property. It might still be a property there, but it doesn't generate any income. So at that point, the lender can't look to the property to pay the mortgage. They're going to have to look to the borrower. So that's why it's a little bit different. So we would call that recourse loan. We might say that during the construction period, as the asset begins to get built, there might be a partial burn off of the recourse, and it becomes partial recourse. And eventually, as that property becomes income producing, we would say now it becomes non-recourse. Think of it to the stages of a construction loan. At first, you've got just raw land, then you begin building. Now there's an asset that has some value, right? And you're in the midst of the construction process, maybe even the entire shell and the windows and everything's in there, and they're just finishing up the interior. That property has value. At that point, the lender can burn off some of the recourse, and it's now partial recourse. Now it's fully constructed. Now it has its certificate of occupancy, the C of O, and now people begin to move in, and the property is now able to begin paying the mortgage. Maybe it burns off completely, and it switches to become non-recourse for the final remainder period during that lease-up phase of the construction loan. Every loan is going to be a little different. Every situation is a little different. So just be aware of that as you go into a construction loan on a commercial property. Don't assume that it's non-recourse because your assumption would be wrong. To me, I found this really enlightening just to give me a clear understanding, again, to demystify some of the complexity of commercial real estate. Once you understand recourse and non-recourse and who pays the mortgage and why, then you can really begin to understand the questions and the information and the details in the underwriting process that the lenders are going through. Your goal is to maximize the loan proceeds for your client, and if you're the borrower, for yourself. And to do that, it's really helpful to understand the way the lenders are thinking. And in this case, you can understand why the lender is so interested in the borrower and the kinds of information they're looking for. And therefore, it doesn't seem so random to you when the lender is questioning this bit about their debt to income ratio, or wants to do another verification of their employment. You'll understand what the lender's trying to do. They're not just going through and making your life difficult or the borrower's life difficult, they legitimately need to know because they need to protect their loan amount. And same thing on a commercial property. When you're wondering why the appraisal is so important, why the phase one environmental is so important, it's not just they're making, again, life difficult. They need to know this information because they need to make sure that that property can sustain the mortgage throughout the life of the loan. That's it for now. If you'd like to learn more about any of the things that we're talking about, you can click on the link below, which takes you to the ACAP Academy, where we go through a deep dive on understanding commercial real estate. And we do that from the point of view of a residential loan officer or somebody new and entering into commercial real estate that may be somewhat familiar with real estate and loan to values and property values and appraisals, but has never really formally learned commercial real estate and doesn't have a lot of time on the job. So the Academy will just accelerate that process for you. We're just going to give you the specific information you need to accelerate your career in commercial real estate. Because let's be clear, you have a great background already. What you need is just the specific knowledge to understand something like this, which we can do in a 10, 15-minute little video like this or a lesson in the Academy. And because you already understand the fundamentals, you're already so far ahead than somebody coming off the street that you just need the specific knowledge to gain, significantly advance in your career. And that's it for right now. Thank you very much for watching.